Okay, well, here we go. The much anticipated fireside chat between Symbiotic and Nexus Mutual. Thanks everyone for tuning in. Okay, so let's just kick it off before we kind of like head into talking about what we announced today, which I think is like kind of what we want to chat about.
Yep.
Do you want to just like give the like what's the Nexus Mutual value proposition? Like, what do you guys do?
Okay.
Yeah.
Yeah. So for those that aren't familiar with Nexus Mutual, although judging from the amount of interactions we've had in Buenos Aires and these side event conferences over the past few days and some of the events that have been taking place, everyone's reactivating and saying, oh yeah, Nexus Mutual, we know you guys. So we've been around since before DeFi summer, about 2019 was when the protocol launched. We are there as the first crypto insurance alternative. We live on chain. We're there to provide a risk transfer marketplace and can provide coverage for all kinds of risks that we can price and model correctly. And that includes things like our protocol cover would include smart contract hacks and exploits, Oracle manipulation, DPEGs, the list kind of goes on. So very sort of plugged into the DeFi ecosystem, also off-chain risk. So some people might not know we were there for a number of our clients that were suffering through the FTX bankruptcy. And so, a number of funds that probably might not have been able to make their quarterly redemption requests from their investors, except for the cover they had with us. So we've been there a good chunk of time.
I want to talk about something that you kind of just hit on, is that like it seems like maybe not all of a sudden, but that like Nexus Mutual and the concept of insurance like doesn't really need to be justified or explained. Do you agree that like wasn't the case 18 months ago in the at least like DeFi space? Like maybe spicy take, but like I think it's fair to say that like traditionally insurance isn't seen as like a sexy topic.
For sure.
Would you
just use the word actuary to
correct, right? They're not often seen in the same sentence, but is that changing? Like and how and why, and like you could just what's your take on that?
I mean, I don't think it's going to become a sexy topic anytime soon, but it has been something that people want to talk tons about. I think everything that's happened in the past few weeks has really caught people's attention. The balancer hack for a protocol that's so well respected, great team, done all the right things, multiple audits, been around, had the very Lindy effect of being around for years with significant TVL, and then they got hacked. So we offered balance of V2 coverage as well as balance of V3, but we have no payouts to make because no one bought the cover because everyone assumed, hey, this thing's been around for ages, no problem. And that's radically changing. I think it's focused minds. Now, will that persist, or is this sort of a brief blip? I think we're optimistic that for this industry to progress and the number of actors coming in that are like professional risk managers, it's changing.
So I think if you're from more of the traditional finance or what we say like institutional side, the concept of insurance is well understood and the need for it. That's maybe a more defined market, but like, is there now, as you mentioned, like because of this was like a hack, there'll be hacks and all, probably, I don't know if I want to say all the time, but like there could be all the time. Is that market just like getting bigger for you guys? Because the like DeFi market is maybe becoming more institutionalized, and so they are appreciating the need for insurance coverage as well.
We've seen a rapid uptake in the number of institutional actors, some that are, say, more DeFi native, the likes of, shout out to Dialectic, Edge Capital, Fasanara, these guys who are professional funds, but also have like DeFi native teams. And they combine the best of both worlds there in terms of their risk management. Those guys are big clients and big users of us. We still continue to cater to the retail marketplace. But yeah, yesterday I was at the Vault Summit and we were talking about the development of Vault Curation, and there's just such a significant step change there now that we're very much seeing that there's a need for sure.
Cool. So let's kind of now just turn to the news of the day, or perhaps the week, perhaps the biggest
Breaking
news of
news
the entire week, in all of this Buenos Aires, or perhaps the world, is that today we announced that Nexus will be using Symbiotic, or be launching with Symbiotic to access deeper pools of coverage and capital, and this really marks kind of a fundamentally new way to access coverage capital. And I'd love to just hear from you. What does that unlock for Nexus and for the broader industry?
Yeah, I mean, there's definitely what it unlocks for us. It's what it unlocks for the ecosystem, what it unlocks for restakers and the wider ecosystem. So for us, we've basically, I should have mentioned some stats here, which is we've underwritten, I think now north of $6.25 billion of cover in the lifetime that we've been running. So we have a substantial multi-year track record. We've paid out tens of millions in claims. But what we're getting to now with the institutional actors is per individual risk, someone that wants to buy cover for Aave or Pendle or a new protocol that's listed, we would say comfortably underwrite $20 million of risk for that one line, but we have very strict risk management ourselves as a platform, and therefore we can't go over those risk limits to risk a significant degradation of the capital pool. So instead, talking to these people that have appetite maybe for $50 million or $100 million cover, we've been looking at solutions on the supply side as we've been ramping our demand side. And now, as it's been in the pipeline for quite some time with you guys, we've been working this over. And this seems like a great way to offer that to our clients that want to buy those bigger covers. And then simultaneously, this is, I think, a really fantastic use case for the restaking world, because there's it's a huge amount of capital sitting with the restaking curators, and they're looking for real yield, real use case that they can apply that to. And we think, this is that.
I think what this establishes, and insurance specifically, but with the ecosystem that now is being built around insurance with Nexus Mutual, with Symbiotic, with the other security stakeholders that you guys work with, that I would love to hear a little bit more about as well. And now a new source of capital. We're creating this core layer of DeFi that seems to be the answer to the question, or the missing piece of what does all the off-chain capital need in order to feel comfortable playing around in DeFi? So not necessarily a question, but just a statement that this is really exciting, because it's really meeting a product market fit on two sides. One is, like you mentioned, the appetite for assets on chain to be more productive, specifically staked assets, and to create these composable financial solutions that are then going to enable much more robust capital pools for all the insurance that a buyer could ever want. Given that, setting the table for that, where do you guys see this business growing in a scenario where you're able to unlock access to hundreds of millions of dollars of underwriting loss coverage? Where could this go?
I mean, we're at it feels like we're at a potentially very exciting inflection point for a takeoff here in terms of the amount of cover. I mean, there's been some other interesting news this week too, where kudos to the Aave team announcing their Aave Save app, where they're going to have some. They say they'll have cover insurance for individual user accounts, and I think with a protocol like Aave that is as well respected, being around as long as it has, with the TVL that it has, the fact that they're saying, okay, we need this sort of cover, is making everyone sit up and pay attention. And just from the conversations that we've been having with people related to that, or to the events of Stream Finance and Balancer and 1010 with the centralized exchange, there's a really big pipeline growing of demand. And yeah, we frankly wouldn't be able to fill it all if we weren't now moving to this next phase with you guys. And I think it's very attractive for the restakers. They'll get this meaningful yield. It's risk adjusted to the extent that like we take on always first loss. They're coming in at the equivalent of like a reinsurance layer. So it's safer that you're not going to get hit straight away. Nexus Mutual would always be there as the vanguard. So then there's this extra capacity that we go to. And it's going to allow the names that we mentioned before that have this pent-up demand, along with a bunch of new people. And I think then the protocols that are distributing and setting up strategies with the neobanks and other fintechs and this sort of B2B to C distribution.
Okay, so something that's also emerged as part of the broader conversation that you guys know a lot about is like risk, how to price risk.
Yep.
And I think it's pretty fair to say that like insurers are in the business of pricing risk. And it's something, having had the chance to get to know members of your team and work with them, you guys have like a deep subject matter expertise in this specific field. Just been interesting to see this kind of like really obvious concept kind of like emerge as part of the conversation for what seems like the first time as it being important. Like it's very hard to assess the value of a certain yield without understanding the risk that you're exposing yourself to. And it seems to have become like kind of normal in DeFi to like not really fully understand what those risks are and therefore not be able to price it. Do you guys see that as like a very competitive angle for your, I guess, supply side?
Yeah, I think that's like the aspect of the trust that we have in the track record. I think that it sometimes feels like the industry as a whole has a sort of binary approach to risk. Like, have we learned the lessons of the past? Talking to shout out to Lee, our head of product and risk. He's goes by Brave New DeFi on Twitter. So really great person to follow to get insights here. He's like, have we learned any lessons here? And hopefully that they will lock in. And for us, anyone can underwrite cover. If you do it too cheap, you're going to blow up. And that's what happened to numerous others in the sort of 2022 era. Got a little too tight, overextended with FTX or with Terra Luna. So I think we've demonstrated this track record of being able to do that. And then most recently, of course, was Stream Finance. So we had numerous funds asking us about that. And we just couldn't get to the bottom of what they were doing. There was too many red flags. So we weren't willing to underwrite. So we will tell people we won't underwrite this risk. Or the price will just be too prohibitive to make it worth for you to execute your strategy. And on that basis, it's a very strong signal both to the demand side that they should be, really understanding the risk, not just the yield. And I think then, like you said, for the supply side, I think it's a strong signal that we're this trusted platform. And for far too long, it feels like everything's just ranked by yield. Let's just put a ranking order of yield and I'll just go for the thing with the highest APY. And now I've had fascinating conversations here with various teams and initiatives around risk ratings that they might put on platforms. But I think at the end of the day, where we really stand is this skin in the game, that the price we provide, it's not just a rating, it's risk capital.
Yeah. And I guess also the advent of risk ratings and that entire concept would also value the availability of insurance coverage because that would impact the risk rating as well.
Something of a feedback loop, I think there potentially.
Cool. Very, very interesting. I could talk about this for another 14-minute fireside chat period, and even more. But I think that's all the time we have. But do you want to? Is there anything else that we wanted to cover that we didn't cover that everyone here in this room should know?
I guess it's just more like a little bit of a look forward to through the end of this year into 2026. We very much think that there's going to be significant, whilst liquidity has been pulled from the market recently and yields have adjusted, there's actually going to be significant redeployment through the market cycle. And we're very positive on that, and basically just very excited for what we're going to achieve together over the sort of next 12 months.
Likewise, very optimistic. All right. Well, I think that concludes our fireside chat. But
Great. It's been a lot of fun.
Thank you very much. Yeah, let's continue it off stage. Keep building.
Thanks, everybody.